Welcome to the first weekly market recap from Hernandez Retirement Services. This week I will begin by looking at the S&P 500 index using price and moving averages. What I review is whether the S&P index is in an uptrend or a downtrend. Afterwards, I will focus on the MSCI EAFE Index and the CME Chicago Board of Trade 10-Year Treasury Note Index. I begin by looking at the chart of the S&P 500 index. This week I'll be dissecting the weekly chart. This chart covers the index from mid-November 2017 up until November 16, 2018. As we can see on the chart, we have multicolored bars. Each bar represents a week. This week we're using the open, high, low, close bars. Each bar shows the full price action of the index for the week. Also, each bar has two handles. The handle on the left-hand side is for the opening price, and the one on the right is for the closing price for the week. Green bars represent a positive week, and the red stands for a negative week. Okay, now we have the basics. Let's add a moving average to the chart. In this chart, we'll be looking at the 10-week moving average. Traders use this moving average as a short to intermediate term trend indicator. If one is using daily charts, it will be the equivalent to the 50-day moving average. Now, as we can see from left to right, this has been a choppy market where the index has enjoyed weeks above the average and suffered below it as well. Now, from early February until May, which I'll show, the S&P was struggling and whipsawing above and below this indicator. But in May, the S&P started an uptrend. Unfortunately, in October, that short-term upward trend ended. Since then, the price of the index has closed below the 10-week moving average. This by itself is concerning, but again, this is just a small piece of the puzzle. Now, in this slide, I add a longer-term moving average to the mix. The black solid line represents the 40-week moving average. This moving average is a long-term trend indicator. If one is using daily charts, this would represent the 200-day moving average. According to Investopedia, this moving average is commonly used in stock trading to determine the general market trend. As long as a stock's price remains above the 40-week moving average on a weekly time frame, the stock is generally considered to be in an overall uptrend. Now, in 2018, the S&P has experienced two major pullbacks, one being from late January until the last week of April, and the one we're currently in began in late September. As of the 16th, it is below this key major moving average. Now in March, there were several occasions where it closed below the 40-week moving average, but it fought through it and began a rally in May. This time, it experienced more time below this moving average, as the S&P has ended 3 of the last 4 weeks below it. Another negative sign is that the 40-week moving average is beginning to flatten. It becomes troubling when this long-term moving average slopes down. Now, does this mean a crash is coming soon? Not at all. But it is beginning to show some true weakness. Next, I will look at the MSCI EAFE Index, which represents the international developed stock market. I will again use the exact two moving averages we use with the S&P. Now in January, as you'll see here, the index peaked. Unfortunately, several weeks after that, price moved below the 10-week moving average, and weeks after that, went below the 40-week moving average. Now this index did have some fight and pushed price above both moving averages. That was short-lived, as in late June, it experienced the dreaded death cross, as we'll see here. Now, what is the death cross? Well, that's when the quicker 10-week moving average crosses below the longer-term moving average. Again, that does not mean a crash is coming, but it does show that this index is of ill health. So finally, if stocks in the US are doing bad, well, that must mean government bonds in the US are doing well. First, let's get this straight. That scenario does not always happen. But enough about that, let's go to the charts. Once again, I'll be using the same two moving averages I used in the previous indices. Now with this asset, we'll go over some questions to see the state of this asset. 1. Is the price above the 10-week moving average? As of close business day last Friday, it was, and that's positive. Question 2. Is price above the 40-week moving average? And as we see, not the case. Price is right now below it, and it's been below it for a while. Question 3. Is the fasting moving average, the 10-week, above the 40-week moving average? And that is not the case. And again, that is negative for the market. So for this index itself, not good news. In fact, the 10-year note has been in a major downtrend since 2017. That does cross happen before November 17. So like the MSCI EAFE Index, this asset is currently an unhealthy asset. So what do we make of this? As I said early in the video, many traders use the 40-week moving average as an important indicator to understand if we're in an uptrend or a downtrend. As of now, all three indices are below it. Legendary trader Paul Tudor Jones has a rule. I'll quote, "My metric for everything I look at is 200-day moving average of closing prices. I've seen too many things go to zero, stocks and commodities. The whole trick in investing is, how do I keep from losing everything?" Unquote. I'll also agree with that rule that playing defense can save one from misery. So based on my rule, I'm not too gung-ho on any of these indices. Doesn't mean they can't recover or even recover pretty soon, not at all. But I like any of these indices to prove to me that they're back in an uptrend. I would like to thank you for viewing this video, and I hope it was helpful. Please subscribe to my channel for future videos.